Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul discuss restricted stock units. In addition to stock options, RSUs are the other common form of equity compensation. They explain how restricted stock units can work like a bonus paid by stock instead of by cash. They go in depth on vesting schedules and the difference between publicly traded companies and private pre-IPO companies. They then compare RSUs to options to help you understand the risks and taxes associated with each. So if your salary is providing for your lifestyle, how can you use this extra money to improve your well-being? And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Today, we're going to be talking about my second favorite topic. Last week, we talked about stock options, both incentive stock options and non-qualified stock options. Today, we're talking about restricted stock units, or RSUs. These are, along with stock options, the other common form of equity compensation, both among publicly traded companies and companies that hope to be publicly traded at some point in the future. So this is the other part of the stock comp or equity comp that I help my clients with that comes up a decent amount, possibly because I'm in the Bay Area, but also these are more common with, again, publicly traded companies, so they are more common around the rest of the US. So we'll get into some of the mechanics, some of the details, and some of the comparisons between stock options and also cash that you could receive and other forms of normal compensation. And we're going to have some fun with this conversation. So, Trishul, when you hear RSUs, what is the first thing that comes to mind for you?
What comes to my mind is the notion that it's just another form of compensation, and it's the ability to reward employees just like stock options, but there's some nuances that we're going to get into certainly over the course of this episode. But basically, it's an alternative to stock options for rewarding employees such that if the price of a stock in the company goes up, then employees will be rewarded instead of through options, this time through something known as RSUs.
Mm-hmm. I like that. Good high-level explanation. The two most common ways I've seen other advisors explain RSUs to clients to kind of help them understand or have a mental framework. You can either think of it as like options with a strike price of 0, which means that they're always in the money as long as the company is not bankrupt. Or I prefer to think of it as like a bonus, but it's paid via stock instead of cash. And that helps you kind of conceptualize the taxes that you owe on RSUs and how to think of them moving forward. So we're going to get into mechanics, kind of regular schedule that comes up with RSUs. But is there anything you want to add in terms of the way you like to think about RSUs when you discuss them with clients?
Sure. I actually like the way you mentioned it in terms of bonus, and we'll get into why I feel like that way a little bit later in this episode. But in my mind, that's a more sensible way to think about it, just because of the way taxes work, especially if you're thinking about it from a private company standpoint versus a public. But these are nuances which I'm glad to dig into throughout the course of this episode.
Great. So the first thing is I like to call it similar to a cash bonus, because when you get a bonus that for your exemplary work throughout the year, and it's a normal cash bonus, it's added to your W-2 income, so it's just regular ordinary income, and your employer will withhold taxes, the normal withholdings, normal federal and state withholding rates that apply to the rest of your salary. The same thing works with RSUs, that when your RSUs vest, they are taxed as W-2 income, so just ordinary income, and they actually do have withholding requirements. So from a normal kind of practical perspective, your cash bonus is taxed at ordinary income and it's what the taxes are withheld. Your RSUs are taxed at ordinary income and taxes are withheld. The other part is that when we have restricted stock units, they make them restricted because companies like to use these as an incentive for you to stay at the company for future years. They think that you're a great employee. They want to incentivize you to stay at that company and contribute your talents to the growth of that company. So there's usually a vesting schedule. One of the more common vesting schedules is 25% vests on the first year, so the first anniversary of the grant date, and then the remaining RSUs vest over the next 2 or 3 years. So relatively common one might be 25% vests on each anniversary for the following 4 years. Another one might be like 25% vests on the first year and then monthly or quarterly for the following 3 years. And this is relatively common, and this is also impacts the timing of those taxes. This is one of the things the IRS kind of agrees that with a cash bonus, you don't pay taxes until you've received that money. They agree it kind of works the same thing with RSUs. So if you can't sell the RSUs because they're not yet vested, then the IRS agrees, okay, you don't owe taxes yet. So that's the first kind of difference and thing to be aware of. You owe taxes on RSUs. They're added to your W-2, they're added to your ordinary income, tax withheld, but on their vesting schedule. So when you're first granted RSUs, the restricted stock units, you don't owe any taxes at that time. You do owe taxes when they vest. So you will see taxes are withheld as each portion of that grant vests over the usually 2 to 4 years. So do you have any kind of things you want to add on about the vesting schedule that you sometimes see and how that impacts taxes?
No, I think that was pretty straightforward, Aaron. I just want to key into just the notion of why somebody might give an RSU rather than just a cash bonus with some sort of schedule. Well, the reason is, let's say you have option A where you just have in somebody's contract, you're going to give them a cash bonus of $10,000 after their first year, and then another $10,000 after the second year, third year, and fourth year. So that's $40,000 total. Instead, what you might say is, well, I'm going to give you 10,000 shares, each valued at $1 today, but the first 10,000 after the first year, the second 10,000 after the second, the third 10,000 shares after the third years, and the last 10,000 after the fourth year. Now, it's 40,000 in today's dollars in terms of the number of shares and the value of those shares, but what this does is this tells the employee, if you work really hard, if we all work really hard, that share price could go up so that by the time that first year rolls around, instead of being worth $1, that share price might be $2. So you're actually getting more because everybody worked so hard and the company did better. That's why a system like this may make more sense than just a standard cash bonus.
And I like that explanation. And one of the things I want to add on to that leads me to my next point is that these are restricted stock units. These are not yet shares of stock. So the units track the share price exactly, but they don't become shares of stock until they vest. There's certain corporate accounting reasons that they have. They can kind of push the stock grants into the future based on the vesting schedule. And if you leave the company, they don't have to actually issue that stock. But it does come into play sometimes if the company issues dividends. So restricted stock units don't have any dividends, and they probably don't have voting rights. So the voting rights and dividends only come into play once the RSUs vest, then they are exchanged for shares of stock. So technically there's nothing called a vested RSU. You have an unvested RSU, and once it vests, the unit is exchanged for shares of stock. That's a technical detail, but it does help you understand that you are granted RSUs, you wait until their vesting date, and then you receive shares of stock. This is also part of what allows the IRS to hold on the taxes until you receive that stock compensation. So that's what they'll use to determine what your compensation is. So this is another small detail. Your taxes are owed when those shares vest, when those units vest and become shares, based on the value at the time of vesting. So we're going to use a publicly traded company as an example. If you were vested 10,000 shares at one, or if you were granted 10,000 shares at $1, and then a year later it's grown to $2, so your first unit, sorry, we said 40,000 shares total vesting over 4 years. Was that the example we had? Yep.
Yep, that's
So you
right.
have 10,000 shares vesting 1 year after the grant date, but it's grown to $2. So you have $20,000 that gets added to your taxable income. The most common withholding structure for a publicly traded company is that they will actually immediately sell enough shares to cover withholdings. So if your withholdings are, say, 22% federally based on current tax laws and a common incomes for people who are getting stock compensation, they'll sell enough shares to cover that 22% of that $20,000 you just received in stock compensation. So you're likely not getting 10,000 shares. You'll be having 10,000 RSUs vest, and I'm going to pull up my calculator and just do some math real quick. They will sell 2,200 shares to cover the taxes withholdings, and then you'll have 7,800 shares left over. And the 7,800 shares are what you now own that as actual stock moving forward. This also determines the basis for your shares of stock moving forward. So the basis is not based on the grant date. The taxes and the basis are determined at the time of vesting. So that's how they're going to withhold taxes. And that's also why it feels like a cash bonus. For practical purposes, you could actually think about this as if they gave you a cash bonus that had a vesting schedule. So you had to wait 1 full year. And then with that cash bonus, after you had taxes withheld, so you could receive the check or deposit in your checking account, you bought shares in your company on that day. That's another way to think of RSUs and the vesting schedule. And what that means is that if you were to sell all of your shares on the day they vest, there's no additional taxes owed. This is going to be one of the things we'll discuss later as part of the strategy, is that if you were to sell everything on the date, you already owe taxes based on the vesting. There's no additional taxes by selling everything else. But if you hold on to those shares, then it becomes a capital gain structure, just like as if you bought the same exact shares in a brokerage account elsewhere. That's another reason why I like comparing it to a cash bonus, is that you could, if the stock stayed flat throughout the entire vesting schedule, you could take your cash bonus and buy shares of stock in the company with your after-tax amount, and you're more or less in the same situation. That's why I like comparing it to a cash bonus that's paid with stock instead of cash.
That makes a lot of sense. But then what are the nuances to consider if it's not a public company, but it's a private company that gives you an RSU?
Okay, so we might be getting a little ahead of ourselves, but I will answer this question. Most of the time, the company is setting up so that it actually has what's called a double trigger vesting. The vesting schedule has both a time component, as in you have to wait 1 year, 2 year, 3 years for each grant, and you have to wait for a liquidity event, usually an IPO or the company's sold. They do this to protect their employees from having to owe taxes on shares they can't sell. That is what they do most of the time. Some stock plans and some companies say they'll vest on the actual IPO date. Other companies will say, no, they're going to vest 6 months after that, after the employee lockup has ended. And this has actually been a recent issue. Uber, when they had their IPO, had the former. So employees owed taxes on the IPO date, but they couldn't sell for 6 months, and then the stock price dropped. So they
Oops.
had owed taxes on the high amount, couldn't sell their shares, watched their shares drop, and when they were able to sell it to pay that tax bill, they were kind of SOL. And so a lot of employees were a little upset at the corporate governance. And this is one of the things that other employers and other IPOs have noticed and tried to make sure they fixed.
Yeah, that seems like a situation where that accountant isn't going to get that many Christmas cards that year.
Not from the employees. Now, theoretically, if the stock price had gone up, then the accountant would have got a lot of Christmas presents because employees would have owed taxes on the lower amount and then they sell them at the higher amount. So it's one of those things where it wasn't bad per se. It was high risk, high reward. I tend to disagree with it because it was the company making the choice for the employees and company making the choice in terms of that spectrum between investment risk and taxes, not the employees making the choice for themselves. That, I think, is the bigger problem that I have.
I see that as an issue too. And you would still have that 6-month lockup before you could liquidate, meaning how would you pay the taxes that were due at the time of the IPO?
Correct. And well, theoretically, if it's in the same calendar year, you can kind of sell them, and you have to kind of talk to your CPA about withholding. So if you withheld enough to cover your salary the previous year and maybe withholding a little bit more, it's possible to get there because of the way the IRS considers salary and paycheck withholdings to be uniform throughout the year. So that's slightly less of an issue in this case for Uber because they did it early in the year. But if a new company has the same plan of they vest on IPO date, but you can't sell, but they go IPO in September, and then so employees would owe taxes on that vest date, but they can't sell shares until March of the following year. That's where it's kind of the company's screwing the employees even more.
Yeah, it just seems like that, like you said, it might be better to wait and not take the risk on behalf of the employees.
Exactly. So that's why I say a lot of companies are getting better about noticing this, but technically that's a company plan. They don't have to add that double trigger vesting. They could have an RSU plan where it's a private company, employees receive this stock compensation and they owe taxes even though they can't sell the shares. The companies can sell it up. And if that's the case, then they'll have to pay it out of salary, out of their paycheck. And that's a strange thing to try and force upon employees. Sometimes the companies might have tender offers, or at each stage of funding, each round of funding, each series, people adding the funding might like to buy their RSUs at that funding price. So there's sometimes liquidity there, and that's theoretically why a company would allow the RSUs to vest before they're publicly traded. This is, again, getting into, is it the company's choice or the employee's choice? So this works better for stock options because the employees can choose when to exercise. With RSUs, the employees do not have a choice. Everything based on ownership of shares and taxes is based on the vesting schedule. So that it's harder to have a plan for a pre-IPO company saying, yes, these shares will vest and you owe taxes on them, but you can't sell them unless there happens to be a tender offer or liquidity event for partial shares. And even then, there's no guarantee that you'll be able to sell all of your shares. So that's why most companies now tend to say there's a double trigger vesting, both time-based and company liquidity event.
That makes a lot of sense. And I think you just snuck in there a pretty big difference between the RSUs and the stock options. I just wanted to make sure we make sure that's clear. So it seems like with the RSUs, you just get them whenever the vesting date happens. They're yours. But the good news is they would hopefully if the stock price is above zero, have a good amount of value associated with them.
Yep.
But with the options, once they vest, you still have a decision to make on whether to exercise the option or not. And
Mm-hmm.
that can depend on a lot of different things, which we discussed in the last episode.
Yep. So a couple of things I wanted to add, because we're in California, when it comes to that withholding, 22% is just the federal withholding rate. They actually also add in Social Security, Medicare. California has state income tax, and also California has state disability insurance. So for employees in California, they're probably seeing about 41% of the RSU value being withheld for taxes. And this might be enough withholding on the state side, but if your marginal tax bracket is over 22%, it actually may not be enough on the federal side. So this is where I need to help clients plan with, even the withholdings for publicly traded companies that they can sell the shares to cover the holdings, that actually may not be enough. They may still owe additional taxes based on this RSUs vesting, depending on their personal income situation, their household tax bracket. So we tend to set aside a little bit extra money from the proceeds of selling that stock to cover the taxes, knowing that the withholdings themselves may not be enough. So that's the standard withholdings based on the 2018 Tax Cut and Jobs Act. So moving forward, if your income tax bracket's over 22%, you probably need to withhold more. It doesn't necessarily have to be like the actual IRS withholding making quarterly payments, but you need to set aside enough cash that you know you're going to have a tax bill next spring.
Right. And that very well could happen, that you end up in that 37% tax bracket, because this is a pretty big event, having RSUs end up being vested. It could very well be that you have 2020, it's 622,000 for a joint household, married, filing jointly. And it's something that you may not think about in normal years, but in this year, of course, it's special. You have a good amount of income coming your way from these RSUs themselves.
Yep. And that's one of the things that even if your income wasn't in that high of a tax bracket, the RSUs themselves vesting can push you into that higher tax bracket.
Yeah.
So this is kind of the schedule that you see. Again, you're granted RSUs. About a year later, a quarter of them vest. Taxes are withheld based on that vesting. So again, assuming a publicly traded company, and you now hold shares of that company with the cost basis equal to the fair market value at the date of vest. Again, we talked about if you wanted to sell all of your shares all in your company stock, there's no additional tax implication. So this tends to be kind of the default conservative, prudent advice from many financial advisors is sell all your RSUs the day they vest. And there's nothing wrong with that. Again, there's no additional taxes, and you're reducing your portfolio from a concentrated position, all in one company stock, likely reinvesting into a diversified portfolio. So we're reducing the risk that you're taking on just on the investment side, and there's no additional tax implication. I like to point out that that's not necessarily the right thing or wrong thing. That's the, again, prudent conservative advice. But if you wanted to hold on to company stock, that is the high risk, high reward side. So holding any single stock, in any company, is high risk, high reward. There's significant concentration risk. But again, like we talked about before, when we talked about asset allocation, diversification, this isn't necessarily an evil to be stamped out. This requires certain planning. Don't bet your retirement dollars on a single stock. And because if that stock does poorly, you need something else to support you. So I don't let clients kind of risk their retirement on a single company stock. But for other things that are technically optional, maybe saving for college or saving for retiring early, maybe the concentration risk could be worth that risk. Maybe the rewards of holding that company stock could be worth it. So do you want to give some kind of quick thoughts and philosophies on concentrated positions, holding single company stock, and what you tend to recommend to clients?
Yeah, happy to. So the terminology individuals may hear as it relates to this particular notion is there are two main types of risk when you think about investing in stocks and the broad market. So when you're investing in a single stock, there's this notion of idiosyncratic risk, meaning there's a certain inherent risk that applies to this particular stock that may not apply to the general market of stocks. And these types of risks can happen with a unpredictableness that if it does happen, the market may be okay, but your particular stock may be hurt. And sometimes you can't do anything about it. Sometimes a particular product comes out from a company and that product just doesn't do well. Maybe there's a lawsuit related to an issue that comes up with management and what happens there. So that there are many things that can happen that are particular to a single company. And that's why having a larger allocation to a single company can be a little risky, because if you have that issue and that issue happens to be with your company out of your handful of companies, well, now your entire portfolio is suffering a good amount. So one way to handle that is to diversify across many stocks. That way the chance of one getting hit is still about the same, but the impact to your overall portfolio can be less. And then the other type of risk compared with idiosyncratic risk is just the risk of the overall market. This is known as systematic risk or market risk. And the notion here is there's just an inherent risk across all stocks that get affected when, in general, large issues change within, for example, the economy or the way the markets operate. For example, a big change is if the market is in a growth area and the economy is doing good, this is going to affect a lot of stocks the same way. In general, individuals may want to understand that if they have too much idiosyncratic risk and too much risk in a given subset of stocks, this can expose themselves to special circumstances that they want to be aware of. And the way we kind of handle this from a practical standpoint is what I like to do is conduct a risk assessment, trying to understand where does an individual stand on the spectrum of being able to tolerate idiosyncratic risk, being able to tolerate the notion of having concentrated positions. And then based upon that, I'd like to give a recommendation. If somebody is risk averse to these types of situations, then I would recommend a more diversified portfolio. And if somebody is able to take on this type of risk, again, it depends on also what your goal is for this money. For example, as Aaron said, probably not your retirement, but maybe that early retirement, maybe you do want to take on some more idiosyncratic risks. Again, high reward, as Aaron said, but also high risk.
Okay, so the systematic risk is the rising tide lifts all boats.
Right.
But to remove the idiosyncratic risk, it's the don't put all your eggs in one basket.
Yeah.
Okay. So some of the things I try to talk about with clients, and again, sometimes it is getting specific. Many times their lifestyle is afforded by their salary. There's based on just their normal salary, they're saving enough in 401ks and or outside of that. This tends to be extra money, if that makes sense, where their lifestyle is not dependent on the RSUs or even the stock options compensation. So we understand what are the risks of holding on to that one stock, but also how does this fit in with your lifestyle and your desired goals? So if this is money that might be a down payment on a house in the next few years, don't reinvest it at all. Leave it in cash. Again, thinking about time frame, and any investment that you take on could go down. You could see a 30, 40% drop in a single year. You don't want to risk the buying the house by having this money invested in the stock market. Get really conservative, leave it in cash if you're going to buy a house in the next 2 years. If this is for education, where if this goes down, if this company goes bankrupt in 10 years, which is possible, or at least goes down dramatically and you only have a fraction of what you had, then the child and you have other options. You can take out student loans. You can go to a less expensive college. You can go to a community college. So you have kind of choices and options, but you haven't risked your personal lifestyle. If this is for that kind of vacation home or that second home or that early retirement, then maybe it is okay to take on that risk. But if you need this money to support your lifestyle, to achieve financial independence, that's where that concentration, that idiosyncratic risk may not be worth it. So it's worth having a conversation about what's the lifestyle you want, what are your goals, and how is this in line with that. Sometimes, like going back several episodes to our happiness research and our discussions on well-being, I talk about things like, don't buy a new car with this money. I know it's a one-time purchase and the company went IPO, so that has extra money, but that won't add to your happiness. It's just going to become part of your baseline really, really fast. I would suggest treating yourself to a nice vacation, that the anticipation of looking forward to that. Now, to be fair, this was the advice before COVID-19, so might have to come up with something new for that example, but it's the idea of looking for those experiences, looking for those memories, and looking for that anticipation. And even better yet, visit friends and family. Again, this was a pre-COVID-19 conversation, but it's like trying to think about those relationships, that friends, family, values, community, trying to combine those. That might be what's worth kind of splurging on with this money, that will likely make your lifestyle better. You'll be happier, enjoy a little bit greater well-being, but don't splurge on the vacation every year. This can't become part of your baseline. That's part of it. We don't want to depend on RSUs for regular lifestyle. And this is a trap I see some clients falling, because some really good employees, they get granted an RSUs 1 year and they vest over the next 4. And the next year they get a new grant of RSUs that vests over the next 4. And then the next year they get a new set of RSUs that grant over the next 4. And so if they're doing well, they keep seeing these RSUs coming and they keep feeling consistent. And it's kind of, there's always 3 years worth of unvested RSUs for some of these really good employees. And it actually does become hard to not plan on those future RSUs coming in, both because you don't know how employment will change. You don't know how the stock market will change either. There can be big swings in the stock market that can affect what you think your income is going to be. So that's why it's hard to internalize that message of, this is extra money. How do we make sure we improve our lives without becoming dependent on this as part of our lifestyle? Do you see anything like that with your clients about consistently getting RSUs, or how to incorporate that into their goals?
Yeah, I think it relates to a point we also brought up in the last episode, where in terms of concentration, your overall portfolio is not just the RSUs that have vested and now are part of your portfolio, but the concentration risk also relates to the fact that your employment is also tied to the same company. And I think you just made another good point, where it's not only the shares that have already vested, but you have to realize if you are getting more of these RSUs, it's just going to increase your concentration even more and more as these continue to vest over time. So that's something you just have to be aware of as you start thinking about how much risk are you putting into the faith or the long-term well-being of one particular company.
I think that's worth exploring a little more. That concentration risk ends up being a really good kind of guiding factor. So both having the conversation about how much of your net worth should be in a single stock, how much are you comfortable with, and the very, very rough ballpark range might be something on the scale of 5 to 20% of your net worth in a single stock. But the super rich billionaires, their net worth is all in one stock kind of thing. So that's where that the upside of that concentration risk is. You heard about Microsoft millionaires, there's employees at Microsoft in the 70s, 80s, and 90s, and all of a sudden their stock's worth has made them millionaires, and they're still working there. That's why there is some benefit. There's some more to that concentration, but a kind of very rough ballpark for, depending on your situation, maybe on the scale of 5 to 20%. The story I like to tell, my wife was an engineering manager at Shutterfly. Or sorry, she still is an engineering manager at Shutterfly, but she had RSUs before the company was taken private. And the stock was kind of bouncing around in the 40s and 50s. And Shutterfly bought LifeTouch. And the stock price jumped up to over $90. And I sold about half of her RSUs, the shares that came from vested RSUs. I sold about half of her shares when it's over 90, and within a few months, it actually went back down to bouncing around about between 40 and 50. And I use this as an example. I'm not a genius. I was not predicting the future. I was not picking the peak. I don't know, like, should I have sold all of the shares at above 90? Did I make the right choice, the wrong choice? It was actually just, we had figured out what our concentration risk was. The share price doubled, so our concentration doubled. So I sold off half of it to reduce our concentration risk. And when we went back down, we weren't hurt as bad. Sometimes it's not a predicting the future. It's not a trying to say, oh, what's the outlook of the company and here's what it's going to do. It's just, we had a plan in place beforehand. Here's how much of our net worth we're comfortable having in a single company stock. That jumped up dramatically. We reacted according to the plan we had in place, and we weren't hurt as much when future randomness happened.
Yeah, that's a very good point. I think what I also like to express is the notion that just because you happen to be an employee of a company, especially if it's public, doesn't necessarily mean that that company is valued such that that particular stock is going to outperform the others. There's no real reason why that would be the case from just the way how markets operate. Meaning, if every given stock on a forward-looking basis should have about the same advantage as another if their market is working efficiently. If one stock is priced less than it should and people realize it, well, then people would buy that stock so that it would be worth more, and all of a sudden it doesn't have that advantage. Now, this is, of course, assuming markets are efficient, but it just goes back to the notion that if you think markets aren't efficient and then you're trying to or trying to pick the stocks that are not timed properly, that's something you can do. It's known as active management, and we've talked about this quite a bit, but the notion is that that's not an easy proposition to do. It takes a lot of thought and consideration, and even then the outcomes aren't necessarily guaranteed. In fact, statistically, there's a good amount of evidence showing that trying to figure out which stocks are going to do better than the other, even if it's the one that you happen to work for, it is not likely going to produce you more wealth on a risk-adjusted basis.
Yeah, that is one of the big challenges, and this adds into why many other advisors recommend selling out of your RSUs as soon as they vest. It's not just the taxes. There's also is a fairly large bias towards your own company stock. And this is almost universal. I'd say 80, 90% of employees kind of think that their company is going to do better than other companies.
Yeah, that's true. That bias also shows up even when people are investing in indices. They tend to prefer the index from their particular country because they feel like that country is more advantaged, and that's why they overweight their country. For example, if in the US, compared to the globe, the US makes about maybe 50% of or 40 to 50% of the global share of stock, but people probably have around 80% of their investments in the US. And what they're basically saying by that is they think that the US will do better than the rest of the world. But it's hard to say, because if everybody knew that, then everybody would put more money in the US and those stocks would be worth more, meaning that advantage would go away if you kind of think about it from that standpoint. And that would be true, same as for your company where you feel like it's going to do better. So it's just a bias that's kind of there and something to be aware of.
Yeah. The next thing I want to kind of get to, we talked about this, touched on very briefly, is comparing RSUs to stock options. So one, we talked about with stock options, you control the timing of the decision, that the taxes and value are based on your decision of when to exercise. We had a whole other episode on how to make that decision and the impacts of AMT on ISOs. But it is just important to understand that with stock options, you control the timing and the decision of the taxes. With RSUs, it's based on the vesting schedule. So you don't have control of that timing. It's going to happen. Now, you know it's going to happen in advance, so you can't plan around it, but you know it's going to happen. You can't really change that. The next thing, stock options, usually when they're granted, have no value. Or at least there's no spread. There's no in-the-money value. There's Black-Scholes methodology implies it does have some value, but the strike price is going to be equal to the fair market value. So you only benefit from options if the stock goes up. With RSUs, they do have value at the time of grant. Even if the stock stays flat, there's still some in the money value because you're granted that stock, and as long as it doesn't go to zero, there's some value. Related to this, RSUs cannot be underwater. So we talked about when you receive an options grant, if the strike price is equal to fair market value at time of grant, you only benefit from the stock going up. If the stock goes down, your options are underwater, and you would never exercise those options underwater. That just makes no financial sense whatsoever. You're going to wait and see how it goes because you could buy those shares on the open market. With RSUs, they can't be underwater. As long as the stock has some positive value, RSUs still have some value. Now you have to wait through the vesting schedule, but that's another benefit of RSUs that kind of makes them slightly lower risk, lower reward than options. Options, you're usually getting a greater number of options, but there's less value there. And RSUs, you're probably getting a fewer number of RSUs, but they have value at the time of grant. And so the options tend to have a little bit more leverage based on both number of shares and the way leverage works. We talked about it last week. So the upside of options tends to be a little higher, but the downside is also zero. If the company doesn't grow, they stay at zero. Whereas RSUs tend to be lower risk, lower reward. You're not going to see as beneficial growth with RSUs as you would compared to options, but you're also less likely to see a big drop in value. The company has to go bankrupt for RSUs to be value. The stock price just has to go down a penny for options to have no value. So are there any other things that you think about when comparing options to RSUs?
Sure. Yeah. Just throwing in that simple example from the beginning of this episode where let's say you have an RSU vesting next year of 10,000 units and currently the price is $1. So that's $10,000, like we said before. And let's compare that to, instead of that, your employer said, I have another option for you. Here's option B, where you can get 10,000 options with a strike price of $1. And the question is, which one do you take? Well, let's play this forward to the following year. Well, now the following year, the stock price, let's say, has jumped to $2. With the RSU, the first case with the RSUs, you're going to get 10,000 shares valued at $2. So you basically got $20,000 worth of income. But in the case of the options, now you have these options that you can exercise, and they're 10,000 options, which could potentially turn into $20,000 worth of stock. But with the strike price of $1, you have to pony up that first $10,000. And then your benefit is the price difference from that $1 to $2 appreciation over that year. So you can see that there is some differences that are pretty significant between being given RSUs and the ability to exercise an option.
I'm going to throw a couple complicating factors in that I have seen. One, they're like restricted stock units are the newer form of restricted stock. So it used to be that companies would actually issue restricted stock and you had certain benefits, and now they offer restricted stock units. There are other equity compensation called stock appreciation rights, which the way RSUs are pretty much the same as stock with the vesting schedule and the way it grows. Stock appreciation rights see all the same growth and the dollars the same as stock options, but you're not actually holding the stock, you're only getting the value of the appreciation. So for all intents and purposes, it's the same as stock options. It's a corporate accounting reason. I have seen employees have a choice between 10,000 RSUs and 30,000 SARs. So it'd be kind of which is worth more, that 10,000 RSUs or 30,000 stock options, because there's no value when the options are granted, they can offer more. It's usually on the scale of 2 to 5 times as many options as you would get in RSUs. And now the conversation becomes a little more difficult. And you can calculate the break even pretty easily, but you do see that benefit of leverage from having more. So in our example of a $1 strike price and a $2 value a year later, the option is going to be worth more because you're going to have a $30,000 value on the options and only a $20,000 value on the RSUs. But if they're both issued when the stock is at $10, then the RSUs and a year later, it's a 20% return. The value is worth $12. The 10,000 RSUs are worth $12,000 or $120,000. Did I do that math right in my head?
Yeah,
Okay.
10,000 times.
So that's $12. Yeah, 12. Yeah, there you go. But the 30,000 options that you had are only worth $60,000 because they only grew by $2. So you actually need the company stock to grow even more for the options to be worth more than the RSUs. And you can kind of see, you can figure out what that break-even price is between options and RSUs. But that is a choice that some companies are now offering employees. It's technically between RSUs and SARs, the stock appreciation rights. But for all intents and purposes, it's the choice between stock or options.
Good stuff.
So have you seen anything else that might be, I don't want to say unusual, but something else that companies are offering to employees and trying to make things more complicated for them?
Yeah, I've seen a good amount of creativity, but basically the reason for that is this can all be negotiated contractually, and it's up to the corporation to come up with plans that are sensible from an accounting standpoint, but also sensible from an incentive standpoint. And when it comes to contracts, you can come up with situations that fit your current situation. So at that point, especially if you're open to flexibility, you can add in a lot of bells and whistles that sound sensible. So I think the main point is it's pretty open, and this space is also evolving a bit, as you've seen with some of the things you just mentioned, Aaron.
Yeah. So restricted stock units, again, while you don't have any decisions to make, there is some advanced planning you need to be prepared for. With stock options, there's definitely a lot of planning you need to consult a tax professional about and consider talking to a financial planner about. So if you have any questions, feel free to reach out to me or Trishul, because these are the areas that, again, I love this stuff. This gets me excited. I've been looking forward to these conversations for a while now.
Good stuff, Aaron. And these are situations where some different planning or choices can make a pretty substantial difference in terms of implication, especially in terms of taxes. So it's well worth it to come up with a solid plan after evaluating what options you have.
Well, thank you very much, Trishul. I really appreciate your time today.
Thanks, Aaron. I enjoyed the conversation, and thanks everybody for listening. If you enjoy these episodes, do let us know or give us some good feedback. We'd love to hear from you. Thanks. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.